Good afternoon, and welcome to the Chicago Treasurer's Office new financial education series by Money Matters Institute, or MMI. I'm Dr. Harita McDowell, the Director of Financial Education and Empowerment for the Chicago Treasurer's Office, also known as CTO. And on behalf of our City Treasurer, Melissa Conyears-Ervin, and the CTO, we really thank you for joining us. The mission of MMI is to empower all Chicagoans with the knowledge and skills needed to make informed financial decisions and to build wealth today for tomorrow. MMI is a 3-session series, including valuable opportunities to learn at every level, online, in person, and through one-on-one financial counseling, all free of charge. Today's session is entitled Good Debt versus Bad Debt. This webinar will help you differentiate between good and bad debt, focusing on credit, cards, and loans, and learn strategies for responsible borrowing and debt management. First, we are joined by Jean Volchek, Senior Vice President of TransUnion Global Operations. TransUnion is one of the big 3 credit bureaus and is headquartered in Chicago. TransUnion maintains the credit histories of millions of consumers worldwide and provides reports to over 50,000 global businesses. Second, Cynthia Jordan Hubbard is the Director of Housing and Foreclosure Counselor for the Conyears-Ervin League Housing and Financial Empowerment Center. Cynthia will address the benefits of financial counseling as it relates to our relationship with understanding good debt versus bad debt. We will begin with Jean of TransUnion.
Thank you so much, Dr. McDowell, for that warm introduction. I'm really excited to speak with you this afternoon. Not only has the credit industry been my professional life for over 30 years, but speaking about the fundamentals of credit is deeply personal for me. As a son of refugee parents who came to the United States in 1978, the struggles of getting their lives together and understanding credit has been kind of fundamental. And so this is very personal for me. Those of you who may have joined this series and our partnership with the City of Chicago and the Conyears-Ervin League would have heard my colleague, Tracy Anderson, last month review the fundamentals of kind of credit scoring and credit reporting. So for those of you who are joining, some of this will be repeat, but in this case, repeat is actually really, really healthy because some of these concepts are confusing. Some of them might be new to you. So for those of you who are hearing this, hopefully this will be as a way of review. And those of you who might be listening to this for the first time, I hope you'll walk away with a nugget or two. Next slide, please. So why is credit health so important? And specifically as it relates to the information on your credit report and how that turns into a credit score, is because it enables access to lots of products and services that we need in our daily lives beyond just access to credit. We'll talk about some of these examples as we move through the presentation, including employment opportunities, how much you ultimately might be paying for insurance, such as auto insurance, and many other things that are so highly dependent on having good and healthy credit. And we'll also talk about the importance of understanding interest rates and how interest rates are determined based on your past credit history. So when we talk about good debt and bad debt, a lot of that is determined by how much you ultimately end up paying for the various types of credit. So next slide, please. Just as a way of review, what is a credit report? Because fundamentally, the credit report is what's used in many credit decisions. Whether you're applying for an auto loan, a student loan, a credit card, it's the information that's contained on your file that encompasses the entire history of your financial obligations, from your very first type of credit that you may have attained all the way through adulthood, the different experiences you may have had. The creditors or the lenders who may have issued credit to you in the past, they're the ones that report the information to the credit reporting agency. Of course, in the United States, there are three major credit reporting agencies. My employer is one of them, TransUnion. Our competitors are Equifax and Experian. Next slide, please. This is just a quick overview, and I know it's an eye chart. We're not going to go into the details, but if you've never seen your own credit report, this is kind of what it looks like. It contains on the left-hand side, you see what are called personally identifiable information. This is your basically demographic data that defines who you are, your name, your address, date of birth, social security number if you have one, as well as potential employment information. On the right-hand side is one example of a creditor reporting your historic credit information. In this example, it's a credit card, ABC credit card, and it shows the date that this account was opened, the last date of any reported information on it. Also, it has the contact information for that lender, and this will be important as we talk about identifying potential inaccuracies on your credit report, contact information to reach a particular creditor. And then the importance of really on the bottom reflection of on-time payment or not. The historical payment information on this particular credit account, it contains the entire history up to 48 months that you're able to see. On the next slide, please. And of course, the different type of loans, from auto loans, mortgage, student loans, credit cards, with the exception of credit cards, let's say, the other types of loans have a very specific purpose. An auto loan is to finance a vehicle. For many of us, it's to get from point A to point B, but oftentimes point A represents your residence and point B is your employment. So it's very important for many of us to have access to a vehicle, and oftentimes we may need to finance that vehicle. Mortgage is another example of financing a need. Obviously, shelter is a very basic human need, and a loan to finance that shelter is called a mortgage. Student loan, likewise, very specific purpose. For many consumers who attain a student loan, it's because they cannot otherwise finance an education. And the purpose of education is to continuously to improve earning potential. So all of these have a very specific designated purpose. We can consider them good debt if managed responsibly. Now, credit card is an interesting kind of a form of credit because it both represents a want and a need when we speak of basic budgeting terminology. A want is something that we may desire, but it may not be necessary to live our daily lives, versus a need is essential. So a credit card could serve multiple purposes. But for many of us, a credit card is usually our first entry into the credit ecosystem. It's how we start our credit experience. Credit cards are usually more easily accessible because they're what's called an unsecured form of credit, meaning they're not secured by a collateral, which is basically anything of value, such as a vehicle is of value. A mortgage is another example, is an asset that could be collateralized in a loan. A credit card is not. So therefore, management of credit card becomes really important when we talk about good debt versus bad debt. Some loans you do not see represented on this page. Let me, for the sake of our conversation, call them bad type of debt. And these would be payday loans, title loans, other short-term loans that are not typically reported to a traditional credit reporting agency. They are reported in what's called an alternative credit reporting agency. The reason why we would like to propose that they are bad type of debt is because of the exorbitant fees and interest rates that consumers pay for these. So we would encourage you to refrain from these to the extent possible, and consider these other types of loans reflected here as part of our basic needs to function and to improve our lives. Next slide, please. So ultimately, the performance of these various loans with each of our experiences are reflected in a credit score. And the credit score is derived purely based on the information that's reported to the credit reporting agencies. And a credit score is typically a three-digit number. Most credit scores, there are many credit scores. We're going to talk about this for a minute. There are many credit scores out there, but most of them range from 300 as the lowest, meaning the highest risk, to the maximum of 850 or the lowest possible risk. But please bear in mind, there are many different types of credit scores and the ranges may vary. What's really important to understand is that all credit scores are built off of, generally speaking, the same information, which is information found on your credit report. Next slide, please. And so most credit scores reflect these top 5 factors that you see here. These are categories, and within each categories, there are many different what are called predictors. Again, a credit score is a probability of some future event happening. In the case of a credit score, it's the probability that you will pay on time or not on your future credit obligation. So, needless to say, the most important factor right on top, as you see on this chart, is your payment history. By far, it is the majority of the weight of any credit score. Next, you'll see is how you use your credit or your credit utilization. We're going to talk quite a bit about this because this also differentiates bad debt from good debt, is your usage of credit. And of course, the age or the credit history drives one of the three, what are called 3 C's of credit, which is character, capacity, and collateral. Well, character is kind of your reputation. So the longer you have had a credit history, the more time there is to bake in your reputation. So this is something that over time, if all else is the same, meaning you pay your bills on time, you don't overextend yourself with credit, all else being equal, over time, your credit score should naturally improve just because you've demonstrated a longer experience of using credit. Inquiries is an industry kind of jargon and term, but what that means is basically application for credit or credit-like services. And usually when there are many new inquiries, that indicates potentially hunger for credit and risk of overextending. Therefore, too many inquiries usually have a negative impact on your scores. They decrease your score. But again, when all else is equal, over time, that application for credit and how it negatively impacts your score should neutralize over time and your score will gradually increase. And then, of course, the different types of credit. So if the only type of credit you have is a credit card, and if you pay it on time and your history extends on it and you're not overextended, your score will gradually increase. But what will really help improve your score is having different types of credit. So it might be an installment loan, an auto loan, a mortgage, and so on, or a personal loan. So having a different positive experience with a different mix of credit usually helps to improve your scores. Next slide, please. It is equally important to understand what is not in a credit score. In fact, it is illegal for any scoring company to incorporate any one of these variables, which is basically what are called protected classes, demographic information, your age, your race, gender, source of income, and so on. Employment information and other demographic information is not included. Let me point out one other thing that concerns information on your credit report that actually does not factor into a credit score, and that's what's called a soft inquiry. I just spoke about hard inquiries, which is an example of applying for credit. When you actually sign a obligation to repay, that is an application for credit, and that reflects on your credit report as a hard inquiry. That means other lenders see that as well, and that impacts your score, the hard inquiry. The soft inquiry is an example where you might be shopping around online and might get pre-approved for a mortgage, let's say, that'll be reflected as a soft inquiry. Or if your current credit company reviews your credit information on a periodic basis, such as monthly or quarterly. That is also a soft inquiry. And probably the most popular form of soft inquiry, many of us receive junk mail with credit card offers and such. These are companies that are looking at your credit report and determining whether you might qualify for one of their products or services, and they send you a marketing solicitation. When that happens, that is a software inquiry, which means only you as a consumer, when you review your file, will be able to see that soft inquiry, but it does not enter into your credit score. So it does not improve or it does not decrease your score in any shape or form. Next slide, please. Some quick credit tips. Um, Again, most important thing that impacts your score is that payment information, that payment history. So please, if you have a credit card or are considering getting your first credit card, um, obviously good budgeting tools and budgeting discipline is very important, but some tips such as setting auto payment, automatic payment, or auto alerts, and many of credit card companies have an application on a mobile device where you can set up alerts when your payment is due, and better yet, set up that auto pay automatically so you never miss a payment. That's very important. Keeping your balances as low as possible, yet using your credit. So it's kind of a double-edged sword, if you will. If you don't have credit, that's not a good thing. But if you have too much credit, that's also not a good thing. So kind of keeping things in balance. And we'll talk about this in greater detail with an example in a couple of slides here. And also, please be mindful about uh, closing your older credit accounts, especially credit cards. Now, if the decision is, I can only manage good debt in a way by once I pay something off, I have to close that account so that I am no longer tempted to overspend and such, then by all means, please consider closing the account. However, if you are following good budgeting principles and you are able to responsibly manage your credit card account, we would encourage you to maintain that old credit card account. Why? Because it represents the age of your oldest credit experience. And there's another factor we'll talk about again on a couple of slides, which concerns your utilization. So it may not always be the best idea to close some of your oldest credit relationships. Next slide, please. Again, it bears repeating again and again. Paying all your credit obligations on time most greatly influences your credit score. And the reason why a missed payment has such a impactful negative impact to your score is because that information stays on your credit report for a very long time, up to 7 or even up to 10 years. So if it's a collection item or a bankruptcy, which is kind of a worse possible outcome, that negative information persists on your credit file for up to 10 years. The good news is if you've missed a payment, and all of us have had life events, then over time, the farther you get removed from that last missed payment, so long as you make it current again, the more likely your score will get back up to where you might believe it belongs. Um, but that's why it's so important that it's really hard to continue to increase your credit score, but it's very easy, unfortunately, to let it drop with just a simple single missed payment. Next slide, please. Now, utilization is a great example of good debt versus bad debt. So what you see here is, let me first define what is utilization. And I'll use a credit card as an example. Most credit card companies, when they issue you your piece of plastic, your credit card account, they will initiate what's called a credit limit. That basically means the maximum amount to which you can spend in any given month. So for example, here, the credit limit is $10,000. So on top, what you see is a balance in any given month that reaches $8,000. So 8,000 out of the limit of 10,000 is an 80% utilization. That is considered generally very high. On the other hand, If the same credit limit is 10,000 and your balance is 1,000, your utilization is therefore 10%. The rule of thumb in terms of impacting that good debt versus bad debt is keeping to below 30%, 30% or lower. Meaning in this example, if $10,000 is the credit limit, keeping your balances to less than $3,000, 3,000 or less in any given month. That's just for one credit card, but it's also a general rule that applies to all credit. So if you add up all of your credit, and you can do the same type of utilization calculation. Now, please bear in mind, when you're talking about an installment loan, such as an auto loan, typically you have fixed payments every month. And so it's kind of easier to plan for, if you will, what your monthly obligation is. And there's very little that you can do to impact that utilization other than prepaying, so long as the lender allows you to prepay, such as on an auto loan or a mortgage. And most of them these day and age do allow you to prepay. So to the extent possible, if you do prepay, that will actually positively impact your score over time. Next slide, please. Again, I'll repeat, the age of your oldest account reflects your credit experience. So it's usually not a great idea to close your oldest account. But again, if you have a choice of am I able to better manage my financial obligations if I just close the account and I'm not tempted by it, then by all means, please consider that. But otherwise, all else equal, it's best usually to keep your oldest account open. Next slide, please. And let me just reflect, why do you have different scores? Well, believe it or not, there are over 3,000 lending institutions in the United States. And virtually every single one of them have their own credit score that they develop as a proprietary tool to assess risk. So that's why you have so many. Plus, there are multiple scoring companies such as VantageScore or FICO, and each of them have multiple different versions of different scores. But again, the most important thing to understand is that they're all based off of the same information, off of your credit report. So that's why on the next slide, it is really important to continuously to monitor your credit report information and your credit score. And one of the ways you can do that is using various applications that are out there in the marketplace, including from some of your financial institutions. They may offer that for free access to your credit report and scores. But usually scores are not offered for free unless you're using an application such as Credit Karma, just to use one example, where you have access to your free Vantage score. And that is a reflection of your credit risk. And it's a good gauge to use. Next slide, please. Let me just cover this one really, really important. Why does this all matter? And how does this all culminate into good debt versus bad debt? Bad debt oftentimes is reflected by how much we end up paying for credit. And again, if your credit score is lower than you would like it to be, chances are you will end up also paying a lot more in what's called interest rate. Now, interest rate when you're borrowing is your worst enemy. When you're saving monies in a high interest rate environment, such as we are in today, it's your best friend because it helps you save more money and build wealth. However, when you're borrowing, especially on a large purchase ticket, such as a home purchase, 1% difference, as reflected in this example, could make such a huge difference. And a credit score is one of the deciding factors of that. So in this example, you can see if the amount borrowed is $300,000 to finance a home, a difference between paying 5% interest versus 4% over the life of the loan, which is 30 years in this example, is over $64,000. And again, think about that. If the difference in the credit score is, let's say, 20 to 30 points, that could be the deciding factor of what determines an interest rate of 4% or 5%. So that's why it's so important to keep in mind all the things we've discussed and how it's reflected into the cost of borrowing and what could really separate a good debt from a bad debt. Next slide, please. This is another reason to really maintain a healthy credit report and credit information, because it could also impact your ability to be employed. Many employers, in fact, check your credit report. Renting an apartment, many lenders pull your credit report. And as I mentioned previously, insurance companies in the state of Illinois, it's perfectly legal to use a credit information as part of their pricing of the policy. So all these things and many more impact our lives. Next slide, please. And again, to reiterate, the importance of, therefore, to monitor your credit information for accuracy and unfortunately, with all the data breaches we hear about in the news, and they only keep increasing, identity theft. Your good name and your good credit could be unfortunately stolen and used to open up credit accounts that you're not responsible for. So that's why continuously monitoring your own information that's reported about you is so important. And the good news is now you can do this for free as frequently as weekly. So this website that you see on the bottom here, annualcreditreport.com, originally when these were set up by the 3 credit reporting agencies, it was to allow consumers access to your credit information once a year. That's why it's called Annual Credit Report. But since COVID, the 3 agencies have agreed to extend that to weekly. So every week you can pull up your credit report from each of the 3 credit reporting agencies, Equifax, Experian, and TransUnion, for free every week. So please be mindful that it's at your disposal, and it's a really good idea to do that. Next slide, please. And the good news is the wrong information happens very infrequently. However, when you do find mistakes, they could be extraordinarily impactful. The good news is that you can correct many of them very easily online by disputing that directly with the credit reporting agency. The example you see here is how it's done with TransUnion. On our website, it's a simple click through. Sometimes you may need to be able to provide documentation, but oftentimes it's very much automated behind the scenes, and within 30 days, usually the information is corrected. Now, what cannot be corrected is legitimate past due or bad history that's legitimately bad history. That unfortunately cannot be fixed. And credit repair shops may promise you the world, but unfortunately they under-deliver because they cannot do legally what you can do for yourself, which is dispute erroneously reported information, not accurately reported past due information. And the last slide, please, is just a few more tips. Is again, don't try to aim for a specific score, but do try to make incremental improvements, because that will largely determine good debt from bad debt. And your score, keep in mind, could fluctuate over time. Don't be alarmed. It's all about the longer history. And please do, just like you do health checkups, consider financial checkups with your credit report information. Thank you for your attention. And with that, I would like to turn over to our partner with the Chicago-Ervin League.
Please welcome Cynthia Jordan-Hubbard, the Director of Housing and Foreclosure Counseling at the Chicago-Ervin League, Housing and Financial Empowerment Center. Cynthia will help explain the benefits of a financial counselor. And throughout the presentation, feel free to post your questions in our chat. At the end of the presentations, we will respond to your questions. Please welcome Cynthia Jordan-Hubbard.
Hi, everyone. Thank you so much, Dr. McDowell. Appreciate that. It's good to be here with you guys. As you stated, I'm Cynthia Jordan-Hubbard. I am the Director of Housing for the Chicago-Ervin League. Our department is referred to as Housing and Financial Empowerment Center. As you see on the screen here, this is our mission statement. The Chicago-Ervin League works for economic, educational, and social progress for African Americans and promotes strong, sustainable communities through advocacy, collaboration, and innovation. HUD, so the Housing Financial Empowerment Center, we are a HUD-approved housing counseling agency, and we provide these types of services as you see below. We provide workshops in financial budgeting and credit We provide workshops for non-delinquency, post-purchase, also pre-purchase, home buyer education, rental housing, and we also provide resolving, preventing mortgage delinquency workshops, as well as wealth building. And we provide counseling and coaching, which is our one-on-one appointments that we provide for those that are interested in coming in, meeting with a coach to discuss financial management, or if you're in need of mortgage delinquency, for those who may have issues with paying their mortgage payments, have fallen behind, and are in need of reaching out to their lender for some type of resolution. We do that, as well as rental housing counseling. So all of these are done on a one-on-one basis. Thank you. Next. This is our department. This is our staff. We're headed by Pamela Stalling, who's our Vice President of Housing. I am, again, Cynthia Jordan-Hubbard. I'm the director, and we have Deirdre Beaver, who's our rental counselor. We also have Pamela Gilbert, who's our pre-purchase financial coach, one of our coaches, and then Evelise Serrano, who is a pre-purchase financial coach and who is our bilingual counselor. Next. What does the financial counselor help you do? So we can help you understand basic financial literacy. We can help you manage your debt. We teach about money management. We can help you create your financial goals and a strategy to work toward them. We help you to understand how money impacts your personal relationship and self-esteem. And we can help you figure out if you are eligible for programs. If you need resources, we can refer you to those places for public assistance and help you understand your credit score. Next. The benefits of financial counseling. Financial counseling can provide numerous benefits for individuals and families. Help you understand your financial situation. Financial counseling helps you gain a clear understanding of your current financial situation. It involves a thorough analysis of your income, expenses, debts, and assets. By understanding your financial situation, you can make informed decisions and set realistic goals. Next. Developing a budget. Financial counseling can help you develop a realistic budget based on your income and expenses. Notice we say realistic, so that we can sit down and we look at and track your expenses, your income, and set something that's realistic for you. Again, a budget enables you to track your spending, prioritize your expenses, and save money. It provides a roadmap for achieving your financial goals and can help you avoid debt. Next. Also, to help you manage debt. By effectively managing debt, you can improve your credit score and achieve financial stability. Financial counseling provides strategies for managing and reducing debt. They also help you develop a client action plan, plus give you resources to negotiate with creditors if possible. Next. Also, it helps you improve your financial literacy skills. Financial counseling improves your financial literacy and knowledge. It provides education on topics such as budgeting, credit management, and investment strategies. By enhancing your financial literacy, you can make better financial decisions and avoid common pitfalls. Next. Also can help reduce your stress levels. Financial counseling can help reduce stress levels related to financial concerns. It provides a supportive environment to discuss and address financial issues. By finding solutions to financial challenges, you can experience greater peace of mind and improve your overall well-being. So for free financial counseling, please call 773-285-1500. This is our main number to the Housing and Financial Empowerment Center that comes straight to us. And at that time, we can set you up with one of our financial coaches. Also, let me just also say, if you know of anyone or you yourself are in need of mortgage delinquency prevention, please call this number as well. I primarily deal with those clients, and I will be more than happy to assist you with that. So whatever you need, we are there to help you. So again, 773-285-1500. Thank you so very much. Thank you for joining us, and thank you for having us, or having me. Thank you.
Thank you so much, Cynthia. That was great. We want to go ahead and answer some of the questions that are in our chat. So I'll be sure to read the questions and reach out to both Jean and Cynthia to see who has the opportunity to answer. We're going to start with the question from Sean. What are the key differences between your credit bureau, well, one credit bureau, yours, and the other two? And that one's for Jean.
Thank you so much for that question, Sean. That's a terrific question. So it bears to explain the history of credit reporting, especially in the United States. So when the three credit reporting companies were launched, they were highly regional. So TransUnion's based here in Chicago. Equifax, for example, was called the Credit Bureau Information Services, which was launched in the South. So they're based in Atlanta. And Experian used to be called TRW, which was formed around the defense industry out west in California. So in their formation, let's say 30 to 40 years ago, credit reporting agency used to be highly localized, meaning whatever business was in that region, they only dealt with one particular credit bureau. Over time, and especially in more recent times, all three credit reporting agencies have become national. So for all practical purposes, the differences in the past that would have been as a result of geographic differences are no longer. Therefore, the key differences usually will be in inquiries. So for example, when you shop for a car loan and you go to a dealership here in the Chicagoland area, they will most likely pull a TransUnion report. And then when you observe all three of your credit reports and you get that loan, you will see the loan typically reflected on all three, but that inquiry will only show on TransUnion. So this is one example where your TransUnion-based score could actually be lower for no other reason than that inquiry. Mortgage is a different industry. In mortgage, by law, it's been traditionally required to pull all three credit reports. So that inquiry will show up on all three. That, of course, is in the process of being reassessed by the regulators and may no longer require three going forward. But usually that inquiry information is one key difference. Others might be, unfortunately, negative information. So, for example, a collection agency might only deal with one credit reporting agency and may show up on one report, but not on the others. But usually those two are the primary differences. There could also be a timing difference. So a particular lender may not report to all three at the exact same time. So if you were to pull all three of your reports at the same time, the same information may not be reflected simply because of the timing. I hope that answers your very good question. Thank you.
Thank you so much, Jean. That definitely answered it for me. I want to ask Cynthia a question that also comes from Sean. How can the Urban League help me secure financing for housing?
We actually have lenders when we provide our home buyer education classes, and we have those monthly. We have lenders that will come on and talk about different products, loan products that they have for mostly, well, not all just for first-time home buyers, but they do offer many incentives for first-time home buyers. But others who may have purchased and looking to purchase something else, there are programs out there that's available. So our coaches that conduct those classes will have that information. And again, we do have guest lenders to come on and talk about the programs that they have at their lending institutions.
Okay, thank you so much for that information, Cynthia. Deshaun, we're going to come back to your next question, but we want to skip to Brian. And this question is for Jean. Is it best to pay the full balance of your credit cards every month?
Excellent question again. Thank you for that. Yes, usually when you pay off your entire balance, there are two things that are happening. Most important in the context of good debt and bad debt is you're really keeping up to that good debt mantra. Why? Because you are not revolving any portion of that balance into the next month, because that's when a credit card really becomes a loan. If you're paying off the entire balance in full, you're basically using that credit card for convenience. So you could have used cash, let's say, or you could have used a debit card. But the problem with debit cards and cash is that information is not reported to your credit bureau. So it does not help you build credit and improve your credit score over time. So the most responsible thing is, of course, to pay the entire balance each and every month. That helps to improve your score, and you're not paying exorbitantly high interest rates, because credit cards are some of the highest interest rate lending products in the marketplace. Great question. Thank you for that.
Thank you so much for that, Jean. Sean has a question about budgeting. Does the Urban League provide any budget training or budget assistance?
Yes, Sean. So we do provide the, again, we have this class also. It's credit budgeting and savings class. We offer that also once a month. And that's exactly what that class is for, to talk to you about budgeting, the importance of budgeting, of course, savings, and how important credit is. So I would suggest you sign up for one of our classes, and they are in the evenings, Zoom from 6 to 7:30. We do have one coming up. Actually, we have one coming up. I do believe that class is tonight, actually. So, but if you can't make that one, it's okay. No worries. We do offer that class monthly. So definitely sign up for one of our financial education classes, and we can assist you with that. You would receive that information from that class. And also, like I said, you can make appointments to see make an appointment to see a financial coach one-on-one. So we'd be happy to help you with that.
That's good news. Thank you so much, Cynthia. They have classes tonight and every single month, and you can register. We had a participant join us last month with a credit question, and Jean, I think that you can help her with this. She wanted to know if her parents compromised her credit, how can she fix it, and is it possible to fix it?
Yeah, that's a little bit tricky question, because it really depends. So if the identity of the individual by a parent or another relative was used without authorization, unfortunately, this does happen a lot. That should first be, the advice is to dispute it with the lender directly. And the lender may ask for proof of that or verification. And it could also be concurrently disputed with the credit reporting agency that may reflect that. But in a case of identity theft, usually it's a law enforcement matter, right? And unfortunately, the example that this consumer states, many people feel uncomfortable filing a police report against their relative. And so therefore, the first course of business that's advisable is to contact the lender and offer an explanation. In more cases than not, lenders are very flexible and they're willing to listen. It might take a little bit more persistence and kind of time management on the consumer's part to do that. But unfortunately, we do hear of these cases, and just by word of mouth is usually not good enough. Most organizations do require some proof of documentation to that effect.
Okay, thanks so much. I love that the questions are coming through here. Brian wants to know, is it best to pay the balance of your credit card in full every month? And this could be for Cynthia or Brian. Like, what is the best option?
Brian, I think you can answer that one better. Sorry.
Yes.
Jane,
I'm sorry.
That one for Brian's question, is it best to pay the full balance of your credit cards every month? I'm sorry, Jean or Cynthia, would you like to answer this for Brian?
No, I'm laughing because I think we already answered that one. I'll repeat. Yes, it's absolutely in the best interest to pay off the entire balance each month, because then you're not incurring an interest rate, and that credit card is not used as a loan, but rather as a convenience, and you're managing to your low utilization. So that definitely helps your credit score.
Thanks so much. And we have a question from Maria, who just wanted to know if the Urban League had an email address or just the telephone number to get registered for any of those classes.
Well, actually, Sure, you can have my email address. That's fine. I can give you that. Should I just say it now, Doctor? Is that okay? I'm
Mhm.
C Jordan. That's CJORDAN, C Jordan at CHIUL.org. And so what we normally do, we have flyers that have the information for each of the classes, and you would go to the QR code or the link on the flyer to register. And then once that's done, you'll receive a confirmation, and you will receive the Zoom link and all of that information to register for the class. So anyone who wants to receive those flyers regarding our upcoming classes, even the financial education class tonight, I can send you that information as soon as we're done here. I can get that out to you. And as long as you register, if you register the day of a class, for instance, this evening, if you want to register for tonight's financial education class, you just have to have that registration in by 5 p.m. But I can certainly send that information out to anyone who wants to, give me their email address or what have you.
Okay, thank you so much. Can you repeat your email address one more time?
Absolutely. C Jordan, that's CJORDAN, as in Michael. No, I'm teasing. C Jordan at CHIUL.org. It's ORG. There you go. Yep.
Thank you. We have a question from Ms. Thelma. I recently received letters from a bank regarding my charge account stating that the interest rate was going up to 35%. Is this a common gesture, Gene?
Thank you for that question, Ms. Ervin. So it is common for credit card companies to change their pricing. The real important question to ask is, why was that interest rate raised? And if it's a matter because of what they decided to do as a credit policy, that may not actually concern you as a consumer, as long as you're using that credit card for convenience. But if you're carrying a balance, then that obviously will greatly impact your credit obligation. That's when that good debt all of a sudden starts migrating into bad debt. So it's really important to understand why they may be increasing that interest rate. If it's nothing because of what you may have done, meaning you didn't miss a payment, you did not go over what's called a credit limit. So they issue you a credit limit, but they will gladly accept you going over the credit limit because typically a credit card company will charge a fee for that. But if you do that, they may in fact raise your interest rate. So it's really important to understand why that's happening. They're actually obligated by law to explain to you the rationale behind their decision. And if it wasn't clear to you, Ms. Ervin, I would highly encourage you to contact that credit card issuer and understand why they're raising your interest rate. Again, if it has no bearing because you're not carrying a balance, then it's kind of immaterial. But still, it's good to understand. And also, it's important to understand that many credit card companies will absolutely negotiate with you. So if you are displeased with any type of a treatment you might be receiving from a credit card, including an increased interest rate, please challenge that. Feel free to contact them because, again, it's a very competitive marketplace. There are literally hundreds of different credit card companies out there, and it's very costly for them to find you as a new customer. They would much rather retain you as an existing loyal customer, even if you may have had a missed payment in the past. They would much rather retain you. And so I would encourage you to negotiate your interest rate if you believe it's inappropriate.
Thank you so much. Again, we have questions from a previous workshop that applies to this one. And this one is about student loan debt, which we know a lot of us are challenged with. What is your advice as it relates to student loan debt going into collections and how it affects our credit, and if we should make a payment arrangement or let it stay there? Like, what is the best advice for those of us who still are challenged with student loan debt?
I can give a first crack at it and invite Cynthia to chime in. So this is a little bit tricky given the environment we're in. So let me speak about traditionally. Unfortunately, even in the worst case outcome, let's say of a bankruptcy, what happens in a bankruptcy is most of your credit is in fact discharged. In a court of bankruptcy law, your credit obligations are discharged. when you consider all the different types of loans, student loans is the one that is not discharged. So even in the case of a bankruptcy, unfortunately, that student loan obligation still hangs in the balance. Now, fast forward to today's both political and regulatory environment, and the tides are sort of changing in that there might be an opportunity to have that loan excused, especially if it's a federal loan. So that's another important thing to consider, whether it's that student loan came from a private lender or the government. Because in the case of a government, there is a chance that it may be dismissed or excused. Not the case in the private. So regardless of what happens politically or in a regulatory environment, that private student loan, unfortunately, you're on the hook. So it's best to, again, contact the lender and try to negotiate some kind of a payment term. Again, you don't need to hire a credit repair shop. You can do many of these things yourselves by just contacting them and see what they're willing to work out. And in many cases, if they have an opportunity to recover a bad debt or a past due obligation, they are more than willing usually to listen to you as a consumer. Thank you for that tough question, but a good one.
You did a great job, Gene. I totally agree.
Thank you so much for giving us a comprehensive answer, right? And mainly that these are some things that we can do ourselves instead of paying for additional assistance. So we appreciate that. As we conclude, please look in the chat box and you will see a link to complete our 2-minute Money Matters Institute survey. That will help us better serve you because that is our purpose. And don't forget, you can also join us this Thursday, June 6th at 6 p.m. for the next in-person workshop for more information on good debt versus bad debt. That's at the Conyears-Ervin League, 4510 South Michigan Avenue. Spread the word and bring a friend or a family member to learn about good debt versus bad debt. Thank you again to our partner, Cynthia Jordan-Hubbard of the Conyears-Ervin League Housing and Financial Empowerment Center, and Gene Volchek, Senior Vice President of TransUnion Global Operations. Be sure to follow us online and in person for more on the MMI webinars and in-person workshops. Thank you so much and have a great day.
Thank you.
Thank you.